when we say capital market instruments, so when we say the chapter is CMSL, that is Capital Markets and Security Laws, we have all seen what is capital markets, what are the pros, cons. When you are entering a capital market, why does any person enter a capital market? In order to make an investment. The main objective is investment. Now, how do you invest? For investment, for any investment that you make, you need certain vehicles for investing your money. Say if you have 1,000 rupees with you, how do you invest it? Through instruments, through financial instruments. Now those instruments which are prevalent, which are used in the capital market, are called capital market instruments. So for example, if you have 1,000 rupees and you invest it in a bank, you get a fixed deposit receipt. So that is called as a money market instrument. Same way, there are different instruments which are used in the capital market. They are called capital market instruments. Instruments used by corporate sector to raise funds are selected on the basis of investor preference, regulatory framework. So this can be a question that is asked. What are the factors that are important for the issuer and investor when it comes to capital market instruments? So the factors are, as far as the issuer is concerned, say for example, it's a company which is issuing any capital market instrument. What will be the factors? First is obviously the cost. What is the cost of raising the funds? When you raise the funds, how it is going to affect your ratios, the debt equity ratio. Third is the servicing of the instrument. Say if you are issuing any instrument, you have to service it. You can't just issue an instrument and forget about it. Say for example, you issue equity shares. You have to give dividend at some point of time. You have to say give rights issues or bonus issues. If you are issuing debentures, as you have seen in the debt market, you have to give interest on a monthly basis or quarterly basis or whatever that is. So that is called servicing. And finally is the rules and regulations. What are the rules and regulations? Are they too complicated? Are they too stringent? Or is it easier to raise funds by this instrument? So these are the four things that they look for. As opposed to that investor, what we need to look for? Against cost of issue by issuer, investor will look for return. You will look for tax. I may get good returns, but what is the tax that I am paying? What is the liquidity? How much liquid are the instruments? And what is the risk involved in these instruments? So these are the four things. Now, if you are going to classify the instruments, how should I classify the instrument? All the instruments you can classify in two types. One is ownership and one is debt. Equity means ownership. The meaning of equity is ownership. So any instrument is called as an equity instrument will give you ownership rights. Or any instruments which give you rights to vote basically at the company's meetings and so on and so forth. You are the owners of the company. And the second type of instruments are the debt instruments, where you are not the owners, you are the creditors of the company. The company is your debtor, you are the company's creditors. Okay, so that is debt instrument. Now all these ownership or debt instruments are further classified into three types. So debt instruments include anything which constitutes a loan, whether you call it a debenture or a bond or a commercial this thing instrument, whatever you might want to call it. Sometimes some countries call it debenture, some countries call it as a bond, depending on what terminology you use. The basic idea is you are the creditor of the company. You give a loan to the company, and the company then services that loan. Instead of taking a loan from a bank, the company takes a loan from you. That's the only difference. Now again, these three can be classified into pure, hybrid, and derivative. Pure is a basic simple instrument. Hybrid is an instrument which combines the best of both. It's part equity share, part debenture. And then there are derivative instruments. Derivatives, as I have explained to you, derives its value from an underlying asset. The instrument as such does not have any value. If you say an equity share, the equity share has a value. And when I say value, I'm not saying the market value. The market value is again derived from something. See, the market value of an equity share is determined by the performance of the company or whatever happens upon the profits of the company. It is derived from that. But any equity share is issued to you at some price. It is called as a face value or a nominal value. That is the price of that equity share. So that is not derived from anywhere. That is the face value or the nominal value, or you can call it a book value. It is called as either book value or a nominal value or a face value. There are three terms for this which mean the same thing. It is the value at which it is written in the books. By that logic, derivatives have no intrinsic value. Their value is derived from the underlying asset. So that is called as a derivative instrument. Ownership instruments give you ownership right. Debt instruments entitled to holder to fixed rate of return. Equity shares, so pure instruments as equity, preferences, debentures, bonds issued with their basic characteristics without mixing features of other classes. Hybrid instruments is it combines the best of both. So what are the examples of hybrid instruments I have given? It's convertible preference shares, cumulative convertible preference shares, convertible debentures, non-convertible debentures, and there finally is derivatives. Derivatives are contracts which derive their values from the value of one or more of the other assets. A derivative itself is merely a contract between two or more parties. The value is determined by fluctuations in the underlying assets. Equity shares. I'm sure you must have studied this in your company law also to some extent. So equity means ownership. Any share means a share in the share capital of the company. So equity shares in any instrument which gives holder ownership right of in this company is called as the equity share. So any instrument which gives you an ownership right, makes you a member of the company is called as the equity share. To that extent, you are the owner of that company. You see Companies Act section 43, equity share capital with reference to a company limited by shares means all share capital which is not preference share capital. So anything which is not a preference share capital is called as equity share capital. That is the definition given by the Companies Act. Now the section also further says that for equity share capital with voting rights or differential voting rights you can issue. The voting rights can be same for all or it can be different for different classes of holders, but there has to be voting rights. If you don't have voting rights, then it's not necessarily a equity share. Characteristics of equity shares are given. Again, this will be a question that will be asked to you. What are equity shares and what are the characteristics of equity shares? So the four characteristics basically they have voting rights. So by exercising their voting rights, they essentially control the management of the company. They essentially control the board of directors of the company. They have a right to share in the profits. When a company declares dividends, what is dividend? Dividend is nothing but the when we come to company declares dividends, what is dividend? Dividend is nothing but the distribution of profits by the company. In that they have a right to have the share. However, they cannot demand that the company declares dividend. That is left to the board of directors whether they want to or they don't want to declare a dividend. That shareholders can't tell you. And finally, when the company is wound up, the equity shareholders are the last to be paid. Since they are the owners of the company, they will be the last to be paid because as per the law, the first payment is made obviously always made to the government, then it is made to secured creditors, then it is made to the employees. After everybody is paid off, if something is left, then it will be paid to the owners. Then we come to shares with differential voting rights. Differential voting rights means the rights regarding voting are different for different classes of equity shareholders. Now, say for example, there is a certain batch of equity shares that a company has issued. At that time, what the company will say for these for persons who have subscribed to this issue. Normally, what is the principle? One share equals to one vote. So if you have one share, you are allowed to vote for one share. You get one vote. Okay? That is the principle of company law. One share is equal to one vote. So if you have 1,000 shares, you have 1,000 votes. But now the Companies Act says that you can also issue equity shares which have differential voting rights. Differential means different voting rights. So now the Companies Act and the rules allow a company to do that. So the rule 4 of a company's share capital debenture rules give the procedure for this. So these are the conditions that need to be fulfilled. There are a lot of conditions A to K. If you want me to tell you what part you need to remember, you have to write point number B, which is important. Point number C is most important. Point number D, you have to write. Between E, F, and G, you can choose any one. Two will be good, but you can choose one also. H, you don't need to write. I is also okay, you can skip that. K is very important. K you have to write. Second instrument is preference shares. As the name will tell you, they are called preference shares. As the name itself suggests, preference shares means with reference to any company limited by shares, that part of issued share capital which carries a preferential right. So any shares which carry a preferential right are called preference shares. Now the difference is they do not have the power to vote. So they are not called as equity shares because you are not the owners of the company, you are not the members of the company, but you get some preferential rights, preferential treatment. And you get preferential treatment in two respects. Number one is payment of dividend, either as a fixed amount or as an amount calculated at a fixed rate, which may either be free or subject to income tax. So it is in that respect, it is more like a debt. If a company issues preference shares, so 4% preference shares, or 5% preference shares, it's almost like a debt. They are almost like creditors of the company. I would not call them strictly creditors because there are certain exceptions also in that. Because say in debentures you have to pay interest every year. So preference shares, more often than not, you have to pay it. But in all other matters, there are just like your debenture holders, they are just like a debt. They are not considered as members. They are not equity shareholders. Do not have a right to vote at the meetings. They get preference in case of dividend. So dividend is at a fixed amount. That amount has to be decided when you issue the shares itself. So when you are issuing the preference shares, at that time itself you have to say that these are 5% preference shares, 4% preference shares. They hold preference shares. They don't hold equity. As I've said, the second preference is in case of winding up. In case of winding up or repayment of capital, the amount of share capital paid up or deemed to have been paid up, whether or not there is a preferential right to payment. So in case of repayment, they will also get a preferential right. So the preferential treatment is in case of payment of dividend and payment of capital in case of liquidation of company. Now, what are the different kinds of preference shares? In that, I will answer your question why I am not calling it as a debenture and what are the exceptions. That will be answered in the coming paragraph. So, they are cumulative, non-cumulative, convertible, redeemable, participating, and non-participating. So, what is cumulative? So, cumulative means, as I said, they are like a debt. In all respects, they are like a debt. Now, the difference is if you don't pay interest on your debentures, on your bonds, then it is called as a default. You are basically in default. You remember section 164 of your Companies Act. It says that company is in default then if you don't pay interest on your debentures. In cumulative preference shares, even if you don't pay dividend for a particular year, it is not called as a default. It gets accumulated. So it is due, it is payable, but it is not a default. Whenever you have money, then you can pay it together. That is called as cumulative preference shares. So the arrears are carried forward and paid out of profits of the subsequent year before payment of equity dividend. So in that case, they get a preference. Before your equity dividend is paid, you have to pay your preference dividend. Non-cumulative is it does not accumulate. If the company doesn't have profits for a particular year, it will not pay dividend. Nothing gets accumulated. You don't get dividend for that 1 year, you never get that dividend. It's gone. And it is not treated as a default. So in that respect, they are not treated as debt. Next is convertible. Again, the word is self-explanatory. At the end of a particular period, they are convertible into equity shares of the company. So for in that respect, they are called as a hybrid instruments. You remember that first table, pure hybrid and derivative. So this convertible preference shares will constitute a hybrid instrument. So you get the best of both. For some amount of time, it's like a debt. For the remaining tenure, it will be a equity. Now in this also, when you say a hybrid instrument, there can be many permutations and combinations that a company can do in this. So in case of convertible preference shares, there are a lot of combinations that can be done. So it can be partly convertible, it can be fully convertible. So partly means say if you are holding preference shares of say 1000 rupees, after say 2 years, either whole 1000 gets converted into equity share. The combinations are partly convertible, fully convertible. When you say partly convertible, only a part of the preference shares will get converted into equity. Remaining will stay as preference shares. So out of 1000 rupees, 500 will be converted into equities, 500 will continue as preference shares. Or it can be fully convertible, which means all are convertible into preference shares. Next, another combination, it can be optionally convertible preference shares. Optionally means it will be convertible at the option of the holder. If you're holding preference shares of say 1000 rupees, you will be given an option. At the end of 2 years, if you want to convert, you convert into equity. If you don't say anything, it will stay as preference shares. Or if you don't say anything, it will be automatically converted into equity. So there are n number of permutations, combinations that you can do. That there is no limit. It can be optional, be convertible. It can be optionally partial conversion. It can be optionally total conversion. And X Y Z. So the bottom line is these are instruments which are hybrid instruments where you get the best of both worlds. Redeemable preference shares, as I said, section 55 of the Companies Act says that a company cannot issue preference shares which are non-redeemable. You have to redeem them not later than 20 years. Only companies which are engaged in infrastructure projects can issue preference shares exceeding 20 years, subject to condition mentioned in Rule 9 and 10 of the rules. So for all other companies, whenever you say preference shares, it means they are redeemable, or if you are going to convert it, it's convertible. Debentures. Now, this one line you can see the definition of debentures in the layman terms. The second paragraph gives the definition of debentures as per the Companies Act. The debenture is a bond issued under the seal of the company, acknowledging the debt due to a debtor. If you can remember this, you'll remember what is a debenture. A debenture is a bond. The debenture also includes a bond issued under the common seal of the company. And what that debenture or bond does is it acknowledges a debt that is due to a debtor. That is what is called as a debenture. So how does Companies Act define it? It includes debentures, stock, bonds, any other instruments of the company evidencing a debt, whether constituting a charge on the assets of the company or not. So it slightly expands it, but basic principle is the same. Okay. So now what are the features? It is issued by a company as a certificate, indicates the date of redemption. So this is important. This can be asked as a 4-mark question. What is a debenture? What are the definition and characteristics of debentures? In this, I'll suggest you write all these 5 points at least, because it's not too much to remember. Because these 5 points are pretty important. I would suggest you at least write these 5 points. Don't skip any of these. Types of debentures. So essentially, debentures are classified on the basis of either their security or the redemption. So when you say debentures means essentially a loan. In case of a loan, you are bothered about the most important thing that you are bothered about is repayment of that loan. That is the most important thing. Of course, you are bothered about the interest also, but more than the interest, your most important thing for you is, will my loan be repaid to me? So in that context, we can classify debentures by the security and redemption. In case of security, so the classification it can be either secured or unsecured. When I say secured, it means they are secured by a charge on the assets of the company. Unsecured means they are not secured by any charge. What is a charge? A charge means anything which is given as a collateral. Specifically using these words because these words are used pretty routinely in your module and other places. It means the same thing. A charge or a collateral means one and the same thing. What is the concept? The concept of a charge is that if the company defaults in the payment of the debentures, these assets will be sold, the money will be realized, and that will be distributed among the debenture holders. In case of unsecured, there is no such thing because there are no assets. Second classification is redemption. Redemption, as I said, there can be either be redeemable or non-redeemable. In case of non-redeemable, as I mentioned, it's something called as a perpetual bond, or non-redeemable debentures can also be say convertible debentures, in which case they are not redeemed, they are converted into equity shares. So nothing is redeemed. The company actually doesn't give out any cash. After a while, it converts the debt into equity. Redeemable means either convertible or non-convertible. Again, in convertible, you have partly convertible, fully convertible, optionally convertible. Okay, so this is again a question that can be asked. Basic features of convertible debentures. So, what it basically means is convertible debentures are basically converted into specified or unspecified number of equity shares at the end of the specific period. The ratio in which they are converted is called as the conversion price or the conversion ratio. So that ratio can be anything. So I have just given an example. For example, the face value is 100, convertible to 2 equity shares, and the conversion price is 50, then the ratio is 2. So for one debenture, you will get 2 equity shares. The 1:2 is the ratio. So that kind of ratios are calculated. And the difference between the conversion price and the face value is called premium. So if the conversion price is 50 and the equity share is at a face value of 10, then you have a premium of 40. And as per SEBI guidelines, if one or more parts of debentures are convertible after 18 months, then a company should get a credit rating approved by SEBI, and fresh rating is required if debentures are rolled over. What do you mean by rollover? Rollover means any debenture carries a specific date on which it is going to be redeemed. On the date of that redemption, you can approach the debenture holders and say, look, either you take your money back or you continue to hold these debentures for another 2 years or another 3 years. So I'm not repaying anything, I'm extending the maturity period, I'm extending the date of redemption. That is called as. This is another topic, sweat equity shares. Again, as the word tells you, sweat equity shares means equity shares which are issued for the labor or for the work that is done by people. Sweat equity shares are generally given not to employees, but they are given either to your promoters or your directors or third parties from whom you buy certain stuff. Most likely it's technology or technical know-how or certain other intellectual property. It is given to employees. There is no prohibition that you cannot give it to employees. See, this is more in case of software things. If say if you have an employee who is contributing a lot of technical know-how to your company. He is an employee, but he has some technical knowledge which is very useful to your company. So instead of giving him an incentive or instead of giving a bonus, you give him equity shares. And it's beneficial for both. As far as the employee is concerned, he is getting it free of cost. He doesn't have to pay anything for those shares. In return for his technological advice or his technical know-how that is giving, he is getting equity shares. For the company, it is beneficial because it doesn't have to pay anything. It just has to issue equity shares. So it's a win-win situation for everybody. So yes, there are certain employees. It is also given to employees in certain cases. Not like there is any prohibition, but more often than not, it is given to persons who are not your employees. Let's say your promoters or directors or some third parties. But yes, if employees is written in the definition, you can definitely give it to employees also. Nothing which prohibits you. The point is that they are either given free of cost or they are given at a substantial discount, which is not the case with ESOPs. ESOPs are not given free of cost. You have to pay for the ESOPs. Then there is something called as a vesting period. Now what happens is, by the rules, there has to be a 1 year period between granting and vesting of options. What it basically means that from the date that you grant an option, only after 1 year can the employee actually convert it into equity shares, that option. And after he converts it into equity share, he can sell it. So the incentive for the employee is, the market price today is say X rupees. If I work hard in the next 2 years or 3 years, after 2 years or 3 years, even if the market price increases 10 times, I am still getting it at 100 rupees. So that is the incentive for the employees. So these are the conditions. Section 54 Companies Act. Company may issue sweat equity shares. The following conditions are fulfilled. So there are A, B, D. I am sure you won't have a problem remembering these four things. Secured premium notes is the next topic. It's nothing but a share warrant. Share warrant is not a share certificate. It is piece of paper which gives you all the rights of a share, but you are not a member. You are not an equity shareholder in the sense your name is not entered in the register of members, but you do get dividend. It is number one. And number two, share warrants is again a hybrid instrument which is convertible into equity share or debt at a future date. It's a bearer instrument, so it can be transferred just by handing over the instrument to somebody else. You don't need any endorsement or anything like that. So the next part is secured premium notes. It's nothing but a share warrant. It can be issued by listed companies. It comes with detachable warrants, lock-in period of 4 to 7 years. So see, these are all regulatory aspects. These are all rules, which are basically conditions which are prescribed by law. There is no way of getting around it. You just have to remember it. Detachable warrants means there is a booklet where there are detachable pages. Basically means you can tear it off. So share warrant is basically a instrument which is convertible into equity shares of the company at a future date. Share warrant is a bearer instrument, means that unlike share certificate, it doesn't need to be endorsed in anybody's favor. If you hand that share warrant to somebody else, he becomes the owner of that instrument. In case of equity shares, you have to give it to the company. Company will register the transfer, and only then you will become the owner. It's not a case in share warrant. I hand the share warrant to you, you become the owner of that. They are not members of the company. Their name is not entered in the register of members. They are a hybrid instrument, is convertible into equity shares. And since they are transferable by delivery, the logical question is how do you then determine to whom to pay the dividend? In case of a shareholder, in case of a share certificate, the company has a record of who is the owner of that share, and therefore it pays dividend to that person who is the owner of the share. Now, in case of share warrant, it is impossible to track the owner because it can change hand a million times without the company knowing it. So, because it is very difficult to track who is the real owner of that warrant, because it can change hand just by delivery, what has been done is the share warrants come with detachable coupons. So if I am holding a share warrant on the date of dividend declaration by the company, I can simply go to the company, give one of the warrants, detach that coupon, basically tear off, it's a perforated coupon. I can tear off the coupon, give it to the company, and the company will give me dividend. There is no approval required, just by delivery. If I give it to you, you become the owner. If you give it to somebody else, he becomes the owner. So the person who is the actual owner, he will claim dividend. But then how does he claim dividend? The company doesn't know that he is the owner. So secured premium notes is basically just like a warrant. It comes with a detachable warrant which has a lock-in of 4 to 7 years. Interest won't be paid within the lock-in period. SPN will have principal amount along with interest. You will get a principal amount along with the interest. The warrants can be converted into equity shares. So it's again a hybrid instrument where one part is equity, one part is debt. In case the holder keeps his investment further, he is repaid the principal amount along with the additional premium. It is mainly a tax saving instrument because the return of investment was treated as a capital gains and not as a regular income tax. So the rate is lower. So it's more of a tax saving instrument rather than an investing instrument. In same is equity shares with detachable warrants. This is different in the sense that the holder of the warrant is eligible to apply for the specified number of shares on the appointed date. And these warrants are separately registered with the stock exchange, they are traded separately. In India, it exists. Non-convertible debentures with detachable warrants are issued, but to my knowledge, proportion is quite few, quite less. It's not very common, but yes, it is a practice which is still practiced in India, but it is not widely prevalent. Debt for equity swap, as the word suggests, this instrument give an offer to the debt holders to exchange for the debt for equity shares. So as far as the issue is concerned, the basic idea is I don't have to pay anything. Swap means you exchange one for the other. You swap it. So you give debt, you get equity in return. You don't get money when you give a debt. You return your debt instruments. Normally you will get them redeemed. Normally you will get your money back. So you exchange your debt with equity. So for issuer, it is good in the sense that it reduces the cash outflow. I don't have to pay anything. I'm getting my debt reduced, and in return for that, I'm not paying anything. I'm just issuing an equity share. And from the investor points of view, if they feel that the company is going to do very well, exchange a share for a debt. Shareholders converting to debt, I have not heard it. Debt to equity, I have heard. I've not really heard equity to debt. So debt to equity is, it depends. So as I said, debt to equity is not something which you can force on your debenture holders. You have to take their approval. The resolution should also state that it is convertible into equity. If you look at a company that there are clear provisions on when you can convert debt into equity. There has to be a option attached to the debt for converting it into equity. 75% of the bondholders or the debt holders have to approve it. And from a company's point of view, it is always, there are two things. One is if the cash flows are reduced, but at the same time, equity base also increases. So your equity share price goes down. From the investor's point of view, if I feel that I'm holding debentures of a company, but then the company is doing really well, the company is posting record profits, then I might be tempted to convert that debt into equity. Because in case of debt, no matter how much profits the company earns and whatever the market price of the, how much well the company does, I'm going to get only a fixed rate of dividend. Even if the company posts bumper profits, my dividend is not going to increase. There is no real difference. It's one and the same thing. It's called as a swap. Conversion and swap are one and the same thing. Then certain additional instruments we are going to see: deep discount bond, disaster bonds, commodity bonds. So these are specific instruments which were issued for certain specific purposes. So as I said, deep discount bond is IDB and CDB had issued this instrument. So these two paragraphs give you just an idea of what are the features of that instrument. Again, it's a debt instrument. Same is the case with disaster bonds. Same is the case with commodity bonds. Somebody asked me a question about petro bonds. That is the answer to that question: petro bond, disaster bonds. So these are issued by companies and institutions to share the risk and expand the capital, link investor returns with the size of insurer losses. The bigger the loss, the smaller the return, and vice versa. So these are typically issued by insurance companies, and the coupon rate and the principal are decided by occurrence of a casualty or disaster and the possibility of borrower's defaults. So what it means is that if the insurance company faces major losses or there are major claims which are made on the insurance company, the interest is reduced. If there are no claims, then you get a better interest. So the interest coupon rate and the principal is determined on whether or not a disaster occurs or doesn't occur. And when I say disaster, it doesn't mean a natural disaster or a natural calamity. It basically means the claims which are made on the company. And these bonds are typically issued by insurance companies who fear many claims being put on them by the investors. Commodity bonds, as I said, petro bonds. So I've just explained what is a petro bond. The petro bond carries a fixed rate of interest. Part of the value of the bonds is denominated in barrels of oil. Okay, so then there will be a floor price, the face value of the bond. So if the oil price increase, the interest rate will decrease. Then there is something called as a carrot and stick bond. So carrot is a temptation that is given to you, and the stick is the punishment that is given to you. So what it means is the carrot is the lower than normal conversion premium, that is premium over the present market price of the equity. Capital index bonds, again, this is asked number of times. This is the bond which is basically issued to hedge against inflation. So what happens in a normal bond is, if you typically take a bond, what happens is you take a bond, say it's ₹1,000 debenture, and you get interest at the rate of say 3% or 4% or whatever that is. So on ₹1,000, if you take say 4%, let's assume a 4% interest, what will be 4% on 1,000? ₹40. But if the prevailing inflation rate is 8%, then you are actually losing money by holding that bond, because you are getting ₹40 at 4%, but the inflation rate at a price rise is 8% per year, whereas you are only getting 4%, which means you are losing money. So to counter this, there is something called as a capital indexed bonds. What capital indexed bond does, what is the difference is, the principal amount, that is this ₹1,000, is not static, it's not fixed. That is linked to your wholesale price index, which is a price index which is given by the government of India, which tracks the inflation. So if the inflation moves up, the price index moves up, the principal is recalculated and again it increases to that extent. And the coupon rate, which is basically interest rate, is calculated on the adjusted principal. Adjusted means whatever is the recomputation of the principal that is done. So by that, it will negate the effect of any inflation rise. So if your inflation increases 2%, your principal will be increased to that extent. And of course, your interest will also increase because it is on the adjusted principal. So if you have ₹1,000 as your principal at 4%, and tomorrow the inflation is say 6%, so there is a gap of 2%. So if there is a gap of 2%, your principal is adjusted upwards. Now there is a formula that is given. How do you calculate the adjusted principal? Inflation index at a given point of time. So let's say the inflation is say 8 divided by inflation index at the time of deposit. So at the time when you took the debentures, let's say it was 6. So 8 by 6 into the principal amount. That will be adjusted principal. And that is adjusted every year or at every fixed intervals. So your principal is always in tune with the inflation. At no point of time are you losing money by holding that bond. So futures and options are basically contracts. You understand one thing. First of all, there is a contract. Or there's a contract between two people or two entities whereby you agree by that contract. One party agrees to buy and the other party agrees to sell certain things. So if there is a contract say between me and say Uma, so by that contract I agree to buy and Uma agrees to sell to me. So what we do is we enter into a contract which says that 3 months from now I will purchase say 1000 kg of rice from Uma at so and so price. That is called as a futures contract. So today we are agreeing to do something, we are agreeing to and we are committing to doing something 3 months down the road. Now what is the great thing about it? As a buyer, okay, I am buying, Uma is selling. If I think that the price of wheat is going to go up, not 1000, say if we agree to buy 1000 kg of rice, Uma agrees to sell me 1000 kg of rice at 100 rupees a kilo. Now I somehow have a feeling that the price of rice is not going to be 100 rupees a kilo 3 months from now. It is going to be 200 rupees a kilo. Then I'll happily enter into that contract. At the same time, if Uma feels that no, the price of rice will fall a bit, it will not be 100 rupees a kilo, it will say be 75 rupees a kg. Then in this case, both of us have our own interest in entering into the contract. Because what will happen is, if Uma is right, she will get benefited because 3 months from now, when the rice is trading at 75 rupees a kg, she has to sell it to me at 100 rupees. She is getting 100 rupees when the market price is 75. On the other hand, if I am right, I am getting it at 100 rupees where the market price is up till 150 rupees. So there is one loser and there is one gainer. But somebody loses and somebody gains and the net effect is zero. So if I lose, Uma gains equally. If Uma loses, I gain equally. So net there are no losers or gainers. It's what is called in financial terms as a zero sum game. It is referred to as a zero sum game because there are no losers or gainers net everybody remains the same. That is called as futures. So it is a commitment. 3 months down the road, I will take 100 kg of rice and Uma will have to give 100 kg of rice. That is called as a futures contract. And I am giving an example of rice. It can be anything. You substitute rice for anything. You substitute it for gold, silver, oil, shares, bonds, anything. That is called as futures contracts. Option is even more complicated. Option is the same principle is the same. Both parties have an obligation. In option, it is slightly different. Only one party has an obligation. The buying party, the person who is buying, may say that I don't want to buy. He can opt out. We both agree on a predetermined price. 3 months from now, this is the price. We are agreeing today. So from 3 months from now, we'll do the contract at the same price. Whatever may be the market price, our price will remain this. In case of option, it is slightly more complicated in the sense that if the price changes, the buyer can back out. He can say, I don't want it. And if he wants to back out, he can do so. But while entering into an options contract, he has to pay something in advance to the seller. He has to pay a commission. He has to pay a fixed percentage in advance to the seller. So if he opts out, that advance that he has paid to the seller is forfeited. So that is basically futures and options.